Thank you for joining us. I'm Adam Myers. I'm an executive director at Pengana, and I'm joined today by Nehemiah Richardson, who is the CEO of the Pengana private credit business. I have a number of questions today, and a number of questions have also been pre-submitted, so we have quite a lot to get through. But if you have any questions, please enter them via the icon which is accessed on your screen, and I will do my best to weave them into the conversation. I think our conversation today is quite important. It feels as if every time I open a newspaper, I see an article about private credit. We've seen references to cockroaches, we've seen businesses, and in some cases, the funds that lend to them getting into trouble. And I want to dig into all of that today. But before I do, I think a question that investors could be asking is, why allocate to private credit at all in this environment?
Yeah. Okay. No, thanks for that, Adam. And, thanks everyone for joining us this morning for the session. I think in really simple terms, private credit still belongs in portfolios because it can provide attractive income, strong risk-adjusted returns, and low volatility, which I think is, very useful in this environment where you see a lot more volatility and dispersion in markets. So, the headlines can really make it feel like the whole sector's in trouble. But most of what's in the news, I think, is really, it's either idiosyncratic events, it's fears around different thematics, or it's vehicle and liquidity mechanics that I think are, generally misunderstood and sometimes misreported. So, but the underlying need for private credit really hasn't changed. Companies still need capital. Banks have structurally withdrawn from, large segments of the market in the US and Europe, and private lenders are able to fill that gap, negotiate, structural protections, and actively manage risk in really durable companies. So I think the answer isn't that you ignore the headlines. It's really about investing in a way that captures the benefits of the asset class while also mitigating the risk. So that really comes down to, I think, from our perspective, and you'll hear me say this many times, and many of our investors who I've had the pleasure of being able to interact with, I always say the same three things, which really comes down to diversification, portfolio construction, and manager selection. So you can mitigate the risks of the asset class and ignore the headlines if you follow, those three things.
Okay, so those are the 3 points. If you are giving investors sort of a simple takeaway from today, it would be those 3 points?
Yeah, 100%. And I'm going to reiterate them again, and I'm going to say them later, and you'll see it throughout, because I think it's really, really important to always come back to three things, okay? First is private credit still deserves a place in portfolios. In a really high volatility world, it still provides you with nice contractual income with structural protections and low volatility, which is really attractive in a diversified portfolio. Secondly, I think diversification in the asset class when you're investing in it means even more today. So that really means across geographies, managers, strategies, and sectors. And you do that because you don't want any single issue or event to become a portfolio event. And then thirdly, portfolio construction and manager selection are absolutely paramount, right? Diversification is about what you own. Portfolio construction is about how you size it and how you combine it in a portfolio, right? So that is, how do you match liquidity? How do you avoid hidden overlaps? And then the manager selection is really about the quality control. So managers who have proven track records of delivering performance through dynamic economic environments, because they have very strong underwriting discipline. They don't behave differently when conditions become loose or tighten. They're very consistent about how they focus, where they land. And I think in particular for us, we focus on mid-market direct lending, where you have the structural opportunity.
Okay, I think that provides a useful framework. If we now step into the headlines, which seem to primarily focus on two large players. One has written down valuations and reduced dividends. Another has restricted withdrawals and sold loans to create liquidity. What is actually going on beneath the headlines? So if you take it down a notch.
Yeah, sure. So I think firstly, and quite obviously, because we all see it every day, there's a lot of noise in credit markets, and I think there's going to continue to be, right? We're likely to see a lot of attention-grabbing headlines, and every day we see them for a lot of different reasons, whether it's about disruption, geopolitical risk, companies need to refinance debt and finding it hard to do so, and then isolated credit events that get treated, in my view, a lot of times much bigger and more systemic than they actually are, right? So what I think is really happening beneath the headlines is simply that there's a lot more fear in an uncertain environment. Okay, so you're seeing markets react to news flow rather than fundamentals, right? So for example, double-digit moves, if you look at the Aussie reporting season, or if you look at what actually happens in the US every day with a different AI or tech announcement, you can see double-digit moves in stocks on a daily basis based on those headlines. And that same dynamic is actually playing out in the credit market, right? Whether it's AI disruption in software, a few idiosyncratic events like the ones that you've mentioned, I think in many cases misunderstood, misreported, or extrapolated into a much broader crisis narrative, right? So that doesn't mean that there aren't risks, because there always are. But I think in many private credit portfolios, you'll find that the underlying fundamentals of the borrowers are sound, right? So I think the key is to separate fundamentals from noise, and focus on what really actually matters, which is, do you have concentrations? What protections actually exist to kind of protect your capital? And is any particular event likely to spread into something that's really systemic?
Okay, so just to sort of hone in on that briefly, are we seeing a deterioration in broad credit fundamentals, or would you say that what we are seeing is isolated?
Yeah, so I guess from my perspective, it's more isolated than it is systemic. Okay, because what we're seeing is more dispersion. Some cohorts are under pressure. A few high-profile events that are actually getting amplified. But the broad indicators, like we see this when we speak with our managers. Default rates, interest coverage ratios, profitability of companies. We're not seeing deterioration. In fact, in some of the fundamentals, we're seeing improvements in the revenue and underlying profitability of companies. And watch lists have been, very stable across our manager cohort. So from my perspective, I don't see that there's any underlying fundamentals that should actually drive some concern around systemic issues, right? So I think, but that said, it's still important in this environment, to have the right posture and to be very vigilant and very selective and not to panic. And I think that's exactly where having, a quality as a system really matters. So what do I mean by, or really matters? And what I mean by quality as a system is you've got quality managers, you have quality portfolio construction, and you have diversification.
So when we next have an event hitting the headlines, which invariably we will, how should investors be thinking about making the determination whether it's isolated or something more systemic?
Yeah, so I guess, and we continue to see it. Any high-profile event can become a headline, and that can then become a broader crisis. So. And I think in some cases you've had allegations of frauds or misconduct, which are very, very different from what's actually happening in the underlying fundamentals. So that's one thing, just as a broad thing. And I think secondly, when you're thinking about this, you really have to think about and understand, where does the exposure sit? You'll find that at the end of last year, we had a lot of high-profile cases. There were large exposures that were reported as being problems with private credit, when in actual fact, right, they were in more traditional channels like banks and public markets, and completely misconstrued towards the private credit market. That's why I say it really matters, like, where does that exposure really sit? And so if you then step back, you kind of go, one, what's actually happened? Two, where was the exposure? What's really impacted? Three, how might it spread, or is there something that indicates that it's something more systemic? And finally, what points you in that direction as to whether to work out the answer to that last question is to also then look at what is happening in underlying fundamentals. Okay, if underlying fundamentals are changing, I think you can feel fairly comfortable, broadly speaking, if you ask those questions, they would be something that's really idiosyncratic. And then when you then look at private credit, it still comes back to the quality of how you invest, which I've already said numerous times.
Yes. So would you say, based on your experience, that the damage is really caused by the credit event or the reaction
Yes.
to the event.
Yes, and I've seen a lot of different events in, say, 38 years in a 38-year career, and I'd say, broadly speaking, it's often much more about the reaction that people actually have to these events. I think single events can generally be managed if you're very diversified. I think the bigger risk that you have that goes to the reaction is confidence shock. Right. Investors can extrapolate one story into a systemic crisis through their own behavioral changes, which then, and those behaviors can be about withdrawals and seeing withdrawals accelerate off the back of that. And then that can create second order effects that are much bigger than what the original issue actually was in the first place. Right. So once again, that's why we focus on the diversification and the portfolio construction to kind of reduce the chance that a headline becomes a portfolio event, because I think it's the portfolio event that can actually create, a lot of issues.
Understood. And based on the questions that were pre-submitted, there seems to be a certain amount of confusion between credit impairment and liquidity pressures. Can you just explain that difference and why that matters?
Yep, sure. So, credit impairment is just really simply that it's when a borrower is actually having some difficulty paying. Okay. The liquidity pressure is actually when investors want to have their cash now, or their fear being the last one out. Right. So sometimes stress is, like I just said before, is actually driven, more by behavior than loans suddenly deteriorating overnight, because generally speaking, they don't. So when fear drives behavior, you can get those feedback loops, right? So, headlines will drive anxiety, anxiety will drive action, and then the actions create more headlines. And I think you see that playing out, you can even see it playing out overnight. So in US markets. So that's why I think the liquidity terms of the vehicle really matter, and why investors really have to make sure that they understand them up front. Okay, because they're often designed at the end of the day to prevent forced selling and to protect remaining investors.
Okay. And we've seen, you referred to the movements overnight, but over the last while, we've seen sort of extreme movements in public markets, particularly software and AI. How should investors think about that in the context of the sort of the read through to private markets?
Yes. So obviously public markets reprice every day. And I think you're seeing a lot more in public markets, which is about, shoot first, ask questions later, right? And software has been a really good example of that. And I think really markets are really trying to assess kind of how AI changes or how AI disruption can really change business durability and business pricing power in the software sector. And I think the equity markets are just repricing that uncertainty immediately. And, you see plenty of bounces that actually happen after those immediate reactions, after people think about it, right? So I think in private credit, the more useful question is, is this a single company issue? Is it a concentration issue in a portfolio? Because you can't really predict, either side of the AI thing. So really what you have to care, when I say that, what I mean is, there's a lot of constraints to AI growing and actually creating the use cases that are out there. And there's I think rightly so, lots of different fears people have about what could happen because they don't know. And so you really have to come back to the portfolio level and really think about the construction, think about the diversification, because that really is your defense. And I would say it's the same in every asset class.
How are our managers thinking about that? AI is going to kill the software industry risk. And one of our pre-submitted questions was really focused on the risk of obsolescence in software.
Yeah. So I think, stepping back, like the point I just made, I think the first thing to say at the outset, like it's very sensible for people to have fear whenever there's these kinds of really large systemic changes that can happen in industries. But and I think there's two sides to the coin. One is AI and the constraints that it actually has to its growth that might actually limit its ability to disrupt. And then on the other side, what business models might be impacted, right? So I think you'll have the AI winners and losers on both the AI side and on the software side. And of course, public markets will reprice that really quickly. But for credit, and then this goes to how managers think about it on the private credit side, the key question is really about whether what AI is changing. And in the context of credit, it's the economics of a business and the durability of its cash flows, and whether a business actually has the liquidity and capability to adapt, right? And then crucially, I think ultimately, as it goes through that process, can it refinance if it needs to? Okay, so that the impact on that durability of cash flow question is really about the profitability at one level, which is, is an AI model going to erode the margins of a company? So you hear a lot of talk about per seat models getting commoditized, right? Or pricing power of software companies being reduced. You also have people talking about the customer churn. And what that means is, does a company itself actually kind of build its own tools and so, not use a software company, or does a new software company displace an existing software company? And so to that question, is there just real displacement? So there's just a software business becomes completely obsolete to its customers, irrespective of those two things. Well, the thing that I think about, what pleases me about our managers, is this isn't actually a new thing. Okay, when they're underwriting software, and I'd say when you underwrite any company, but software in particular, the things that they look at are, what are the things that can impact on the underlying economics of the business? Okay, so, AI is just another transition, and a manager will look at these fundamentals, look at how they might impact on a company, and they've been doing it for quite some time. This isn't a new thing. Our managers, if you talk to them, they've been looking at this for years, right from the beginning of people talking about AI. It's just become, a much bigger news flow more recently. But the fundamentals of how might this company that I'm investing in going to be impacted by the things that could disrupt its business models and make it obsolete? That is not a new question. That's a question that's fundamental in software lending.
And in actually all industries that they lend to.
100%. Okay, so then it comes down to, how do I feel about the company's core competencies and competitive advantages? You hear a lot of people talk about proprietary data, because in AI eats up all the public data. If you have proprietary data that can't go into an AI model, nothing can be done with it. Okay, so if you're a software company in a business and you have the proprietary data, you actually have the ability to transition your model to actually increase your core competitive advantage by introducing AI tools in that environment to add more value to your customers. Then it really becomes about the sizing, of the sizing of the loan, et cetera, et cetera. So this is just, I'll just say it's not a new thing. I'm not dismissing it. It's an important question, just like any industry disruption is. And then once again, your protection comes down to the quality of the manager, the consistency of their underwriting process, the diversification of their portfolio, and then back to us, the same thing.
And just to answer the question, which has come through more than any other that we've received, how much software exposure do we actually have in the portfolios?
Yeah, so at the high level, we manage all of our exposures, with different sector concentration guidelines, et cetera. So that's that at the outset, and that goes to the whole thing about quality portfolio construction. But our current exposure to the information technology sector, okay, so you're talking about IT services companies as well as software across our whole portfolio, is 11%. So it's only and that includes software. So that's the sum of its component parts. And so, I think rather than, quoting one number in isolation, I think the more important point for investors is that the portfolio is deliberately diversified, right, across managers. We have 26 managers, over 4,500 individual loans. Of that, there's only 11% that's related to information technology in any way, shape, or form. I talked about the fact that our managers have, been thinking about this for quite some time in their underwriting of software companies. So, where I sit, I don't see that software really is a single point of failure in our, highly diversified portfolio.
Okay. And another question that's come up in various forms seems to indicate a level of confusion between the vehicle and the underlying assets in the vehicle.
Yeah.
Can you maybe unpack that a little bit for us?
Yes. So, different vehicles can own similar assets, but they can behave very differently because they have different structures. And what I mean by structures, they might focus on different investor bases, and they might provide investors with different liquidity promises, right? So, a listed vehicle price moving or a fund managing liquidity doesn't automatically mean that the underlying loans are failing, right? The asset is the loan and the borrower cash flow. The vehicle is how that exposure is actually packaged up, financed, and priced day to day, from investors. So, sometimes a vehicle actually becomes a story, even when the underlying credit is not the driver. And I think we've seen, some evidence that in some of the news flow over the last couple of months.
Okay. We've probably delved enough into the headlines now. So if we were to take a step back, what genuinely drives long-term outcomes in a private credit portfolio?
Yes. So I guess coming back to the kind of the repeating theme, I think the one word to say, it's really about discipline, right? And so, when you think about manager selection, managers who have proven track records of delivering performance in dynamic economic environments, they've got proven underwriting. They're selective about, the deals that they originate. They have very strong ongoing monitoring. And they have the ability to intervene early, and they have very good workout resources if that's actually required in situations. Secondly, with discipline, it's about the diversification. So making sure that you're spreading your exposures across manager strategies, sectors, geographies, so that you don't have any single risk that will actually dominate the underlying performance of your portfolio. And then it's the portfolio construction. So how do you size and combine those exposures? How do you avoid hidden overlaps? How do you match underlying liquidity expectations attached to those assets, and how do you keep the risk kind of where you want? And I think it also matters, where do you sit in the capital structure, right? So, the seniority, the covenant protection and controls that you have, and then how you can manage refinancing risk. So, so for me, I think really the best protection against all of this is the discipline of the manager, but also the discipline in how we, from our perspective, how you select managers, how you diversify your portfolio, how we construct it in a way that seeks to eliminate correlations, et cetera. And that's really what it's about. It's not about kind of reacting to headlines. It's really about how you maintain that discipline, because if you look over time, that's where the best performers in private credit are the ones who maintain that very consistent discipline about how they invest, and they avoid increasing their buy box, if you will, because of external environment. They just remain very consistent and disciplined.
Okay, so basically, discipline, experience, portfolio construction. You've highlighted all of those. Underwriting and documentation probably also critical.
Yes. Yeah.
How do standards today compare to sort of the peak of private credit?
Yes. So, I mean, for sure, documentation has generally improved compared to when we're in the frothiest parts of the cycle. And I think that's kind of a natural thing on a more generic level. And what you'll find is in peak conditions, or, in industries where, you have, I guess, hyper focus from a lot of managers and a lot of competition, you can actually see covenant packages loosen. You can see, more aggressive behaviors. But I think for sure today, and for, probably over the last quarter or two, you're seeing broadly in the industry that lenders are becoming much more selective. Protections are becoming stronger in many areas where they had previously been loosened, and spreads are starting to increase as well. And that's also why I come back to the manager selection is so important. And from my perspective, in working with Mercer, we really back managers who we feel will walk away when terms don't compensate them for risk. And that's what I meant when I talked about increasing your buy box. One of the things that we really get concerned about is, during cycles, how does a manager actually make decisions about increasing its buy box. And if you maintain that consistency irrespective, you're going to see that dispersion in outperformance. And with those who actually kind of move with the times, you'll start to see dispersion with underperformance. So that
buy box is sort of an indication of style drift. Is that correct?
Yeah, sorry, indication of style drift. I use buy box if that's style drift. Exactly. And so you want to have people who maintain very disciplined and consistent risk appetite, consistency around how they underwrite, right? And I think if you have that through cycles and people can prove that they do that, you can feel very comfortable with investing in those managers.
Okay. Now, a question that's just come through is you keep saying diversification and manager selection are the best protection. What does that mean in practice?
Yeah. So it really means that well, in credit, you can't ever say that you're not going to have issues, right? And I think in any broad credit universe, public or private, you're going to have idiosyncratic events. And the goal really is to make sure that you're minimizing, the frequency, but also the impact of events, so they don't become big events in your portfolio. And so, I come back to, we separate these three things very clearly. The first is you want to be diversified. So what we own, we want to spread our exposures across manager strategies, sectors, and geographies, because we don't want any one thing to have some big impact on our portfolio. Okay. Secondly, the portfolio construction, which goes to, so if you think about diversification is actually the ingredients, the portfolio construction is actually the recipe. So how do you put all that stuff together? How do you size individual exposures? So, how does that whole mix look like in a portfolio? And then finally, it becomes about the manager oversight, the manager quality and the oversight, which is really about choosing the managers with the proven track records, the underwriting and management disciplines that, that I've said before. And I apologize, I keep coming back to the same things, but I think it's very important that what's really important at all times is to maintain that disciplined process. That's what we like out of our managers, and that's what we feel is really important in working with Mercer in how we manage our own portfolio.
Okay. You've mentioned Mercer a few times. For people who don't know, we work very closely with Mercer. We're lucky to have a big brother who helps us out as we allocate and construct portfolios. How does the Mercer process actually strengthen what we do?
Yeah, so
Mercer involvement,
yes, and it really does it in a couple of different ways. Number one, in the manager selection, they have a very strong track record over, they have a dedicated private debt team that's been around really, from the inception of the industry. So, a couple of decades. And, their knowledge of the managers and the strategies, the quality of the investment due diligence process, which really goes to, the people and process at the manager, how they manage risk, the governance that they have in place in terms of how they operate, how they do independent valuations, how they behave in stress, all of those things that go into identifying and diligencing to get the best of the manager cohort, if you will. And then secondly is about how they actually assist us in our portfolio construction to help us to, ensure we're diversified and minimizing concentrations and correlations in our portfolio. And then third is, they do provide us with support in the ongoing monitoring of the underlying managers and performance of the portfolio, as well as, holding the, managers to account and the things that they promise and how they're actually delivering on those promises to us. And I think if you put those three things together, that independence, that long track record and history of diligence and understanding of the sector and managers, it's really great to have a partner that helps to support us in that way, to help us to deliver a very high quality product to our investors.
We've just received a question about MFS being placed into administration amongst allegations of fraud. Now, no portfolios, especially portfolios as diversified as ours, will be immune from issues altogether. Are there any problem credits within the Pengana portfolios that investors should be aware of?
Yeah, so I think on MFS specifically, our exposure is small. It's around 10 basis points. If you assume, full loss of capital, it's a 10 basis point impact on our portfolio. And it's with a manager that I can say identified anomalies early, they stopped funding, and is actually currently working through, the recovery processes, in that situation. Now, we can't eliminate fraud risk. Nobody can in the world. But I think what's really important is that you have someone in the driver's seat who has some disciplines that allow for early detection and active management that improves the chance of getting a better outcome. And, I've seen something the other day where, there's a local manager that actually has exposure to the same situation. And I would say that they probably weren't a driver in it that actually did the early detection, that caused, the funding to stop of MFS and various vehicles. They're more a passenger that would have actually, participated in the funding of the vehicle, but they really wouldn't have had those early detection, the early detections to kind of stop that from happening. So we really, when we're looking at our managers, we want managers who are the drivers and who aren't the passengers, right? And I think that's critically important. And it's also why, once again, you want to be diversified. And you want to construct portfolios to kind of mitigate any potential for, correlation or systemic risk in your portfolio.
I think it really highlights the value of diversification.
Yeah.
If we were to talk briefly about how our portfolios are positioned today.
Yes. So at a high level, our portfolios continue to deliver exactly as we've kind of designed it. And so that really means, stable income focused outcomes with a very defensive posture. Okay. There's no emerging portfolio-wide any portfolio-wide issues. In all of our discussions with all of our managers and looking at all the underlying data, like the key leading indicators, would all say that the portfolio is in really good shape, and there's really nothing that would keep me asleep at night about our ability to deliver on the outcomes that we're trying to deliver for our investors. I think the other thing to really note that's quite important, because it is one of the key protections that you have, is that our portfolio is predominantly senior secured lending, right, with really good protections, relatively low LVRs, that 30 to 50% sort of range. We're highly diversified across our managers and strategies and geography. So you come and you put all of that together. The underlying performance is sound. We're really highly diversified. We have tried to minimize as much as possible correlations and concentrations. So I feel quite confident, where I sit today, that we're not really being impacted by idiosyncratic events. And I don't feel like there's any systemic things that, could drive adverse outcomes in our portfolio.
Great, thank you. That was a useful summary. I think we've covered quite a lot of ground today, and what I often try to do is to sort of summarize the key messages, but I don't want to risk overcomplicating. So if you take us back to where we started, what are briefly the core messages that you want to leave people with who've listened to this webinar?
Yes, so come back to the three things. Firstly, private credit still has I think, a very important role to play in building the robustness of investment portfolios, particularly in this volatile environment that we live in. I think secondly, diversification. When you're in private credit, diversification really matters. You don't want any one single thing to have an impact on your portfolio. And then thirdly, you want portfolio construction and manager selection are absolutely paramount, because that's how you really you get two things out of that. One is you don't have correlations that you don't see, so you're trying to minimize that. And secondly, managers who have that proven track record of delivering that performance and building robust portfolios in their own right are really critical to getting the outcomes.